Hi, Brennan McCarthy, Certified Financial Planner with Boulevard Wealth Management here in Eden Prairie. Seen a lot of talk in the news recently about bear markets, and I wanted to talk a little bit about what's going on in the stock market right now, what we're seeing here at Boulevard. So, a bear market's defined as a 20% or more decline in the overall market. The S&P 500 officially reached that bear market territory on June 13th. It closed that day down just over 21%, and it actually bottomed a few days later, just below 22% from the all-time highs on January 3rd. Actually looking into the details there, most of the names that have been hit hardest are the ones that outperformed the most during the COVID crisis. So in many cases, people do believe that things just got too far ahead of themselves. Those high growth names, those Facebooks, Netflix, Coinbase, you heard all about them during 2020 and 2021, the Tesla, Zooms, Amazons. They've actually seen their holding values decline by 50% or actually more in some of those instances. And many of people that I'm talking to are wondering whether it's wise to stay invested in these names, stay invested in the stock market at all. I've been asked the question, should I pull out, wait for the bottom, and then get invested back in? There is a clear answer. The answer to that is no, but let's talk about why that is. So the chart that you're looking at here contrasts the 2020 COVID collapse from prior bear markets we've seen. We do believe it's important to separate out what happened in 2020 from prior bear markets just because of what was going on. There was too many things happening that are not like a normal market. A pandemic that we haven't seen in over 100 years, and then government intervention that kind of halted that downturn and immediately turned things back up. So in this case, we're going to say exclude 2020 from our data and look at what the average bear markets look like. So there's a pretty clear trend here, and we'll go through some on the next slide. But in year one, immediately following a downturn, after the bottom is set, we average a 40% return for the first year after that set. The second year, we get 13% returns averaging in the past, and then in the third year, we get a measly 1%, and that's really been a clear pattern. So let's look at the next slide to see if we look at those prior 9 bear markets, you can see that trend across every single one of those periods. So again, excluding 2020 downturn, that pattern's clear. Strong returns for the first, 365 days after the bottom is set, and then lower, but still decent returns in year 2, and then flat to negative returns in year 3. What can we learn from this, and why does that mean that we need to ride the downturn? So what we know is that when things turn, they turn very quickly. So let's look at some of the main takeaways here. When the market reverses trend, it turns very quickly, and that's why it's important that we stay invested, because we don't know when the bottom is going to be set. So we get to ride this down, and that first initial pop from the bottom is usually one of the stronger ones, and that's why we have to stay invested. Historically, the best returns are when market sentiment, or think pessimism, is at its worst. So immediately after the bottom is set. That is when pessimism is at its absolute lowest. It's also when returns are the best. And so again, that's why it's important that we stay invested. The next, doing nothing, or actually even better, buying more when things are bad and when pessimism is bad, has proved to be the best strategy. It's what the best investors have done in the past, in past bear markets. Those people who sell now when the market's falling, they're locking in their losses at a low point. If you don't sell, you don't really lose anything. That's important to think too. Investors who are moving to cash right now during these downturns, they often miss that initial bump that we talked about, that bump that hits very quickly after the bottom is set, especially when pessimism is low. And when the trend does ultimately reverse back, they miss that best return period, that first year, and even more specifically, it's the first couple months after the bottom is set. So those that do miss that initial bump have historically destined themselves for very poor future returns, and so that's why it's important that we stay invested. We stick to a strategy that hopefully was in place before the downturn occurred, and we're actually, in Boulevard's case, buying things that are down right now, and we're buying things on sale. And so that's what we're seeing right now. Let me know what questions you have. I'd love to hear your thoughts.